Okay, guys, welcome back to another YouTube video. I was actually thinking about an intro that I could use for this YouTube video, but I could not come up with anything. So I'm just going to go straight into what we have for today. Well, this YouTube video is supposed to talk about what makes a trade or what makes a setup worthy of putting money on the line, and we're going to go through what I personally, as a trader, have as a checklist and what every setup needs to meet as a criteria before I assume risk on it. Now, what we have here is a flowchart that I created on Lucid Spark, and it just has three parts: how I learn, how to, you know, how I basically learn new things. This is basically how I learn everything, and the main part is how I view trading after 7+ months of intensive study as a trader. Um, I don't know if you know this, but I've been trading for less than a year. But, but, don't let that discourage you. And I am fully convinced that if you sit through this video, you will find something useful. Now, for a successful trade to exist, I expect that trade to have three elements to it, just three. Not more than that, not less than that, just three elements to it. And they're as such. Now, the first and most important element to every trade setup that I, try my best to do take, because, you know, excuse me, human error is a factor. We are not perfect, but to the best of my ability, I try to make sure every single one of my setups that I assume risk on meet these three criteria. And they're as follows. The first one is higher time frame context. And when I say higher time frame, well, I'm talking about everything above the 4 hour chart. So the 4 hour chart and above, that's what I consider as higher time frame. Some people consider the 4 hour mid time frame, whatever. It doesn't really matter what you call it. At the end of the day, what determines whether it's higher time frame, lower time frame, mid time frame is the type of trader you are. If you're a scalper, well, the 4 hour chart is basically your daily chart, is like your higher time frame. If you're a swing trader, well, you probably execute on the 4 hour chart, and your higher time frame is probably the weekly chart or the monthly chart. So it's very relative. But the first and most important is the HTF context. The second most important is the framework slash structure. And then the least important and the last part of my trading checklist is the entry model, right? So this is the last thing that I look, to check off my bucket list, my trade bucket list. And as you can see here, there's millions of entry models, and it's very arbitrary and relatively unimportant. What your entry model is doesn't matter as much, because your entry model essentially is your risk definition. It basically entails, okay, what am I assuming risk on? Where's my stop loss? Where's my take profit? But let's not be too fast. Let's go back to the beginning. HTF context. What do you mean by HTF context? Well, for you to have, a opinion on the market, the HTF context is what I use to frame that opinion on the market. Bias, if you would, right? So my bias is framed with HTF context, and I use, some different ways to do it. I don't just stick to one thing, because a lot of times, the market is not as simple as a lot of people would like to paint it. But I don't care about other people. I'm trading for me, so this is what I do. Well, sometimes I use volume, not sometimes. I use volume, especially the VWAP. I use the VWAP on the higher time frame to, find how price is trading relatively to ranges, right? So if the volume is lower as it's trading higher, is price, repeatedly touching it? Is it, expanding rapidly and not touching it? It gives me an idea as to what price might be about to do when I combine it with the rest of these concepts. None of these can really be used on their own. It depends on who you are as a trader and what you choose to do. Personally, I use them hand in hand, and I use them in a very, I'm kind of like a gunslinger. I use them in very different ways, but the concept is basically the same, right? So all I do, I use these to find a reason to say, okay, I want to look at this market and I want to see something, right? So based off of either volume, quarterly theory, whether maybe we're trading in the distribution cycle or we're trading in the manipulation cycle, or maybe I'm scalping and I'm looking at time, maybe we're trading in macros or, a micro cycle or a reversal cycle, lunch reversals, whatever. I consider stuff like this. And it looks like a lot, but I, basically have lots of competitions firing off of my head whenever I'm trading. I'm thinking about a lot of things and examining, what I would need to assume risk. And once I'm done with that, I then go into the framework, but I'm not done yet, right? So we have volume, we have quality theory. The next up is the market maker models, and the market maker models are a subsidiary of the IPDA, price delivery cycle, the interbank price delivery. I think I've forgotten what A means, a paradigm or something, whatever. Um, Essentially, what I use this for, I always try to identify where consolidations are because consolidations are usually used for targets. I usually try to identify when the market is expanding away from a relevant level. I usually try to identify if we are reversing or if we are retracing. These two are very important concepts, and I'm going to highlight them in a way. These are very important concepts because whether it's reversing or retracing is important because usually retracements are distributions and they're usually very slow and choppy. Meanwhile, reversals are usually expansions away from a key level. So it gets complicated, but stay with me. Now, once I'm done determining whether, are we consolidating? Are we expanding? Are we reversing? Are we retracing into a key level for a continuation? Because retracements are based on the idea that, okay, we are already expanding and we are dropping lower or higher into a PD array to continue the expansion. Or if we're not retracing, well, we probably are reversing. If we're not doing any of these, we're probably going to be consolidating where we're not really moving in either direction and we're moving in a very tight range. Now, on to the next. Once I'm done with HTF context, I go onto the structure. Now, as much as I am reversing, retracing, expanding, consolidating, I want to see the structure support that, right? And the concepts relating to structure as the second step of my checklist, where we have ICT PD arrays. I would consider myself an ICT trader. I don't really know, nor do I care. But I learned lots of these from ICT's YouTube channel. You should check it out. Um, and please don't listen to what other people tell you. Go check it out for yourself and know if it's for you or not. I agree, it's not for everybody. Some of his videos are like 2 hours long. They bore the hell out of me. But he has what I want, right? And I'm willing to sacrifice the time that I need to learn what I want to learn. Anyway, we have ICT-PD arrays. We have the kill zones slash macros. This is a time element of framework where we have kill zones, the x-axis of trading, and then we have standard deviations when we're trading the market maker model. They're all interrelated. We have HTF candle closures, daily bias. And I stroked it out because I don't like using daily bias, but I know how it works, so it helps me. And I would consider you learn how to do it too. Some people, including myself, I don't find daily bias as to be really important as to when I want to take a setup. I consider other things like the things I have just mentioned. But it's important that you know how it works because when you know how it works, it helps you on every time frame. Essentially studying how candles work. And finally, ranges. I feel like I don't even feel like it's a fact. Ranges are probably the most important part of structure if you're to go by, what I'm talking about here. Or basically in trading, just trading in general, ranges, it's important to know what range you're in because it helps you know if you're consolidating, if you're expanding, if you're reverse, it's very important. So ranges are something that you should definitely know. It's definitely worth exploring what exactly these are, right? So there's that. And then finally, when we're done with the HTF context, we're done with the framework. Well, we go into the entry model where we define our risk. So the entry model we use to define our risk, and we used to say, oh, okay, I want to see price trade into this level, and I want to open a position at this level. And after I open that position, I don't want to see price trade to this level, or else I'm going to close the trade. Or if price trades into this level, I'm going to take profits. Also, I believe that every entry model should have rules for partials, and you should not partial like an animal. If you open a position, you should have rules in place to keep you from toying around with the position. If you open a position, you open 10 lots, 20 lots. Don't just, oh, it's gotten to this level, I'm scared, let me close out half of my position. Doesn't really make sense, right? So you should have rules in place, and you should actually know what your trade expectancy is. That's why you should know how to do math. I talked about this in one of my other YouTube videos. You should know how to do math as a YouTube trader, not as a YouTube trader, as a trader, right? You should know your You should know your trade expectancy, and you should know what exactly it is you're trying to make slash risk. You should know everything about your position. You should not trade like a degenerate. So now that we have covered the main three steps of my checklist, my trading checklist, we have the fundamental sentiment. Essentially, what that is, we have the economic calendar drivers, the economic calendar, we have red folder, yellow folder, and I use these in conjunction with quarterly theory and cycles. And I also, consider bank holidays depending on what bank. If it's a US bank holiday, well, it's it affects US dollar pairs, which is basically almost everything. The indices market are based on the US euro dollar, basically any forex pair that has the USD, the indices, the US stock indices, right? The Nasdaq, the S&P, the Dow Jones, the Russell E Mini. And then, we have the red folder from the economic calendar. We have the holidays in the red folder. So I mostly focus on the USD holidays. Let me make that clear. USD and red folder. And then we have this guy, President Trump. I should have put his picture here. He is a very important person that you should listen to. I don't care if you like him or not. He is important. You should probably listen, keep an eye out for what he says and what's going on in regards to him, because basically he just executed a pump and dump on every single one of us who trade the US stock market. But that's a talk for another day. Yes, he is now part of the fundamental sentiment. He is basically an unpredictable forex factory. Anyway, let's get into the video. Okay, so I simplified the diagram, and now all we have is a very streamlined process that we want to follow. Previously, I showed this entire checklist that is like very complex, but it can be simplified to just this. And as much as I've studied these things consistently every single day for the past like 6 months or so, it looks complex, but if you put the time in, you get it. Now, looking at this, we have three things to look at, just three things: the higher time frame context, the framework slash structure, and the entry model. Now, if you look over here, this is the daily chart on the NASDAQ futures contract. And I want to go over a trade that I took on Wednesday live on Discord. And I also shared the trade in my Telegram. And I'm going to take you through it, how I was able to capitalize on that trade and, what I was looking at. So first things first, what's the first part of the setup? First part is the higher time frame context. We're on the daily chart, and we use our structural principles and the IPDA, market maker models, whatever it is. We use that knowledge to frame an idea on the higher time frame. What's the idea? Well, the idea is on this range, price took the low, is expanding from this relevant swing point. In an expansion, we expect continuations. Price won't continue to go high, go up forever, and it won't just start tumbling down. If it does, it would probably give signs, probably start consolidating first, and there's a process. So, since we're expecting a continuation sometime, we're expecting, a bearish day and then a continuation. So, this is Monday. This is Friday, sorry. This is Monday. This is Tuesday, right? So, on HTF context, we have this range trading higher continuation. My idea for this would be the IPDA cycle continuation, where I'm focusing on fair value gaps. So the context would be a daily fair value gap. That's simple. The context for that trade is a daily FVG. That's simple. Really, really simple stuff. And then going for the framework, we're going to drop down to the 6 hour and then the 1 hour to better understand the intraday dynamics and what is going on. So this is the 6 hour chart. And to the right here, I have some markups that I have hidden. I'm going to show the first one, which is the framework. It's not going to be visible on the 6 hour. I said it not to be visible on the 6 hour. But essentially, the idea for going to the 6 hour chart is the 6 hour chart shows you every session in a candle. We have the 4 hour chart, but this is only available with the premium or the whatever trading view plan. You can't get it for free. You need the basic or whatever. So we have this low. These are relevant swing lows. We purge the first low. But again, if we're just trading purges without logic, well, we get this where we get purged again, this low. So trade lower into a relevant swing point, start to consolidate, right? All of this is inside of Tuesday. And then on Wednesday, you can see we open and trade lower into this level, relevant swing point. This is the range high. So on a bigger scale, if you're to be swing trading, this would be your target. And if you're scalping, you're gonna have to go into the lower time frames. So our context basically is a daily fair value gap continuation, right? On the daily chart. Daily fair value gap. Let me make that visible on all intervals. And on the 6 hour chart, you can see the daily fair value gap right there. The same as that low. This low is the daily fair value gap. So that is our context. If you go down to the 1 hour chart, we have the rest of our framework, right? Where we have the SMT, where we have SMT at the lows, and we can take that out because it's not as important as the rest of the stuff in this setup. So context, daily fair value gap, let me keep tabs on it right here, context. And then for the framework, well, what I do for the framework, I identify the range because we're always either trading inside of a range or creating a new range. So the framework, based on this, you have the context, daily fair value gap. The framework, we have multiple parts of it. We have SMT on the weekly cycle. So that is weekly cycle SMT. So the higher time frame framework is a weekly cycle SMT plus the range play, which is range low, range high. We have context daily fair value gap. We have the framework from the 1 hour. You have the SMT, the purge, and then a missing part or the last part before we get to the entry is the driver, the news driver, what we have on the economic calendar, and the key time. So for that, I'm going to go down to the 15-minute chart, right? And right here, you can see we have the 8:15 news driver, and I'm going to get the text. It's not visible on all intervals. I'm going to get that. And right here, you have the text. We're going to add the news driver to that. It's a red folder, right? So I'm just gonna say a red folder, and then we have our context, our framework, and our driver. So if I go to the bar replay, right, and I start right here where the news driver drives price into a relevant swing low, relevant swing point, we can go through the process on the 1 minute chart of how price progresses after it takes this relevant swing low. So we are bullish. We are below the true day open. We are below the true week open. I don't need to mark that out because basically this is the Monday open. Monday open is all the way up here and we are down here. So we are below the true week open and trading down here. This is midnight, right? So this is the true day open. We are also below the true day open, right? So these are levels that we want to see price return to, and we want to see price return to key levels around that area. So I'm going to turn on my entry markup, but it's not going to be very visible until I play the candles that actually led to those. Now, for my entry, I was focusing on these equal highs, even though we had the true day open over here. Right? That's our true day open. I'm going to make that. So even though we have that there, I was focused on these equal highs, and that is what we will focus on in this video because as a learner, as a beginner, you don't really want to hunt for home runs or crazy risk to rewards. You want to hunt for the low-hanging objective of the day, which is these equal highs, low resistance liquidity run, right before the daily true open. So you don't even need to see price get to the true open. And all the way from the bottom here to that high is like what? How many points? Like 134 points. And there's so many setups that one could have taken. So I'm gonna go through it and I'm gonna, explain as price progresses what is going on. So we're going higher. First thing we do, we inverse this fair value gap. What does ICT call this? A balanced price range. You have sell side delivery, and you have a quick buy side delivery on the exact same set of candles that run out sell side liquidity, right? Where is sell side liquidity? This right here is sell side liquidity. I'm going to change that to sell side. And these down close candles that run out sell side, we have an order block at that level, right? So relevant candles running out sell side, inverse for value gap, we change the delivery state on the lower time frame on this last candle. If we inverse this fair value gap right here when we close outside of it, I'll probably take this as a inversion. Could also take this as an inversion, but on the day this happened, I did not take the inverse fair value gap setup. I wasn't even looking at the markets then. I wasn't looking at the markets then, but I didn't take the inverse value gap setup. And I wasn't bothered because my plan was to trade at 9:30. I was not bothered about anything before 9:30. But if you were trading before 9:30, this would be perfect. It's not a bad setup. Inverse value gap, relevant candles that sweep or take a relevant low or high relevant swing point. We inverse that fair value gap. Well, let's continue. We trade into it. For example, if you were to trade this, right, your entry would be right at the inverse fair value gap, right? Where's your stop? I would set my stop to this candle, this relevant candle that has traded down below. That's the 8:45 candle. That is a relevant time. If I turn this on, you're not really going to see much, but 8:45 is a relevant time. If I turn this on, 8:45 is a relevant time. Your entry is going to be right at the inverse fair value gap. Delete this. Okay, take two. Your entry is going to be right at the inverse fair value gap, and your stop is going to be right at the open of this candle that expands and expands past this level. Now, this is a very high risk stop loss, and your best bet would be to set your stop right below the order block low. So you're not expecting price to get all the way down here. That would be your best bet. And that's also why I didn't want to take this setup, because it's like 5 hour, yeah, but like I wasn't watching the market, and if I was taking this is where I would put my stop, right? This is also a good level to put your stop, but you want to be safe. If you want to be safer, experience, it's very discretionary, to be honest, and you can put your stop basically anywhere, right? It just is based on how much you're willing to risk for, risk to reward. There's like a graph on it. It gets really complicated, but for the most part, we have this inverse fair value gap. That is why if you watch ICT videos, if you notice, it doesn't use the RR tool, because it's very, very discretionary and it's not really important. It's not important to price at all. So we have this inverse fair value gap. You could buy here, right? Your stop right, at this level. We're going higher. We're trading into that place. We're not, take note of the fact that we are not closing outside of the inverse fair value gap, right? We're trading out of it. Once we close outside of the inverse fair value gap, right? Once we trade out of it and we close outside of it, this becomes a reclaimed fair value gap. This level right here, I'm going to turn this up, extend it. Okay, it doesn't even work on the replay. But once we break out of this inverse fair value gap, it becomes reclaimed, because we traded through, even though we didn't close through it, traded out of it, and now we're trading back into it. So, this could also be a viable entry where you can buy again. We already have an entry. So trading higher, once we go higher and we break above this, we can set our stop to this low, and then we'll not expect price to go any lower. So let me go forward, and then we expand again past this relevant gap. This is a relevant gap. Why? Because it is a candle and a gap that was formed on the liquidation of a relevant low, right? So it's a relevant gap, distribution lower into relevant key level. These are all key levels. Key areas of distribution on the opposite side of a curve in a market maker buy program or sell program usually support price higher. So this is a relevant gap, and this would also be a key level that I would be watching price to see how it reacts to it. All right. So we're going forward, seeing price, it comes right into that relevant gap, right? Trades, accumulates. It trades out of it, but notice it never closes outside of it. This is how you know the price is progressing smoothly, and you can prime and prepare to take setups, and trust that you will not get stopped out. I mean, you can't really know if you get stopped out or not. And that's why you backtest and you study patterns and the way they form repeatedly. And you do it long enough, you'll be able to do stuff like this, right? Because this is something that I did. I'm not just showing you something that I'm just cherry picking. This is something that I actually did. And I've done this multiple times from my Telegram channel, my Discord. You're free to go fact check, like it's all there. The history is all there. So trading higher, trading higher, and then 9:30 opens higher and we close above this. So at this point in time, I posted a message on Discord that I will be looking to take a setup if we close above this place, this short-term high. Why is this short-term high important? Because it was the short-term high that began, it was the inception of this run on liquidity. So this short-term high is a key level that I would look to probably enter from, because you want to enter from key levels. It doesn't matter what the key level is. It could be an order block, it could be anything. But this is a more advanced entry because it's not one of the more obvious ones. Like, the more obvious ones would be like this inverse for value gap, this order block, which some people who like would have entries here, they probably won't get failed, right? This is like a basic setup that some people would take. It's not bad, but it's not as advanced as this. Not a lot of people would see that this is a relevant point in price. And it's only relevant because of the market maker cycle it is in. This is the high, the short-term high that created this relevant swing point that took out the relevant low. Traded out of it, closed above it after 9:30, right there. At 9:32, it doesn't really matter when that happened. We already have our limit. Once we break above it, remember this is the 1 minute chart, so we have about 2 minutes before price comes to our entry. So we have our entry right there, and essentially I had this level marked out for partials, and I wanted to take off 50% there. I was trying to pass a challenge too, so I wasn't really, it was kind of as much as I took this trade. Like, it's so funny, but I took this trade and I still, like, based on my journal and based on my stats, this was supposed to be a day where I made like over $600, but I didn't make over $600, and it was because I flopped and I basically didn't, follow my rules to the T. But I was profitable today, like on Wednesday the 4th of July, not the 4th, I think it's the 3rd or the 2nd, I can't remember. But this is the entry, trading higher. I'm yapping too much. And then, I took partials here, 50% partials, and then trading higher right there. And one candle right through the equal highs, daily objective met. And to be honest, if I'm trading with size and, I won't really be interested in trading anything else. But because I'm trading evals, I want to like capitalize on the most setups that I can. And of course, I'm going in, with proper risk and with the amount of money I'm willing to put on the line in my head and at the back of my head. And I'm not forgetting it. I'm not over leveraging, and I'm keeping multiple things in my head. And I'm like, there's so much that's going on in the market, and I'm just keeping an eye out for almost everything. And I'm just watching it, seeing how price is reacting to these levels, and, vice versa. So that is basically how you scalp. And even right here, if we had added a position, let's say we go back a little bit, right? And let me go back here. Right, we buy. We buy again. We buy again. That would be it. And if we took these three, trades on just one micro each, that's about, $509. And that is also, there's like so many ways one could trade, and I can't really talk about everything. But this is basically just the setup. that I took, and price went on in the day and traded even higher. But I didn't really care about that because I was done for the day, and that was it, basically. So without further ado, even as much as we had this draw, if you were to hold, you will not be like in the wrong because we still have a target over here. And that is also how you can capitalize on minute chart setups for higher time frame targets. But that's a story for another day. As you can see, we eventually got to the range high objective, right? And it's a large range, and a lot could have been capitalized on. But that's it for this YouTube video, and I don't want to take too much time. I will see you in the next one. Make sure to drop any questions you have in the comments below, and I will also be taking questions on the Discord, YouTube, anywhere you can contact me, basically. Yeah, I will be answering your questions, any questions you have at all, right? That's basically it. I'll see you in the next YouTube video.